How's it going, everybody? So good to see all of you once again. Welcome back to Money in Life TV. My name is Mike the CPA. On this channel, we make videos around finances, investing, and taxes. In this video, I hope to help you minimize taxes when it comes to investing throughout the course of your life. This is the second part to the tax diet, so I hope you guys enjoy it. I think you're gonna get a lot out of it, so I encourage you to watch it until the very end. I've saved the best tip for last. I have 5 tips in all for you guys. Okay guys, I'm gonna jump into the information right now, but real quick before we get started, if you guys like this video, let me know by crushing that like button or leave a comment down below. By doing so, it's gonna help this information reach more and more people. All these tips I think are really easy to implement, and you're gonna see why. So the first one, and the first 2 are very related. So the first tip I have for you guys is to be a long-term investor. Now, why do I say that? Because if you're a long-term investor, which means if you're holding an investment, whether it's a stock, an ETF, mutual fund, whatever, if you hold that investment for a year and 1 day or longer, you're gonna get long-term treatment. And when you get long-term treatment on a stock sale, for example, there's a special thing called capital gain tax rates. If you don't know, capital gain tax rates are much less than ordinary income tax rates that you pay on your wages. So for example, the highest ordinary income tax rate is 37%, whereas the highest capital gain tax rate is only 20%. If you think about how that adds up on large dollars, so that's a pretty substantial savings, right? On like 100 grand, 17% less tax is like $17,000 more in your pocket because the investor held the stock longer. You'll notice that depending upon your filing status and your overall income, when you go to sell your investments, you might actually be able to pay 0 taxes if your income is low enough. And that's even if those investments are held within a taxable account. So it's pretty cool. So a lot of people out there, if they own investments and sell them, they can actually pay 0 tax on those gains. Very cool stuff. So pay attention to the long-term capital gain rates. And I have a whole video on the capital gain taxation rules that I'll link below in the description. So when it comes to investing, one of the first and simplest things you can do to minimize your taxes, and I should say that the tax tips I have for you guys today are within a taxable brokerage account. Not talking so much about a Roth account, we talked about that in the first part of the tax diet series, but more so in a taxable brokerage account, the things we can do to minimize our taxes there. So for you, when you're thinking about investing, think long-term if you want to minimize your taxes. Being a day trader or a short-term trader is not your friend. Short-term is defined as anything that is, if you sell an investment that is held for exactly 1 year or less. So just by holding your investments long-term, it's gonna help you save on taxes when you go to sell them. The second tip I have for you guys is all about dividends, and it's very related to the first tip. If you guys know how dividends work, you know that if you buy a company, for example, let's say you buy Johnson & Johnson stock. Let's say Johnson & Johnson, they pay a dividend on a quarterly basis. So let's say on March 31st, you receive that dividend. Well, that first dividend you receive is probably gonna be classified as an ordinary dividend. It says ordinary because that means you have to pay ordinary tax rates on that, which you don't want. So how do you fix that? Well, I'm gonna put the rules for qualified dividends on screen here. You can pause the video and read it for yourself. But basically, once you've held Johnson & Johnson stock for like 6 months to a year, when you start to get dividends from the company, after that period of time, they're no longer gonna be classified as ordinary dividends. They're gonna be classified as qualified dividends, which means you get the same amount of money, but now you're paying less and less tax. And you didn't do anything different here, right? The only thing you've done to get the qualified dividend is just hold onto that stock long term. So when it comes to investing and when it comes to minimizing your taxes, think long term, not short term trading like all those day traders who are trying to sell you their stock courses over YouTube. The third tip I have for you when it comes to taxation and investments is, do you really need to sell that right now? What do I mean? So a lot of us who own a taxable brokerage account, let's say we might have several investments that have large unrealized gains in them. Unrealized meaning we haven't sold them, so we don't have to realize any tax yet. And that's important for you to know. Many people out there, I find, don't know that you don't pay any tax at all on stock sales until you actually sell the stock. So you can actually own Amazon stock, for example. You might have $1 million gain on Amazon stock, but you won't pay a dime, not even a nickel in tax until the day you start to sell some of those shares. So when it comes to you wanting to start to sell some of your shares of your ETF, mutual funds, or stocks, think if you should really sell it all at once, or if you should sell it off in bits and pieces. And here's why you need to think about this. So let's say you have a $20,000 gain on a stock, and you're thinking about selling it. Well, most people, they don't think about taxes, so what do? They usually, let's say they own 100 shares of that company. They sell off all 100 shares at once, and now they're stuck with a $20,000 taxable gain that they gotta pay all at once. What most people don't do is they didn't consider their other forms of income. See, your wages, your dividends, your rental income, business income, all that adds up and affects your overall tax rate. So when you go to sell an investment at a gain, all that income is going to be added to all of your other types of income, which might push you into a higher tax bracket. You don't want that. You want to avoid that. So by paying attention to how much total income you have from other sources, and by looking at the marginal tax rates, those tax bracket tables, you can help keep your income low enough by being strategic of how much of your investment you sell at once to keep your overall income low. By keeping your income as low as possible, you're going to avoid bumping up into that higher tax bracket, which you do not want to do. So you might, for example, instead of selling all of your shares at once, maybe you sell some of your shares in December, and then you sell some more of those shares in January 1st of the next year, to help keep your total taxable income down as much as possible to not bump up into that higher tax bracket. Something to consider, something to watch out for that most people aren't thinking about when they're going to sell investments. The next tip I have for you, number 4, deals with selling investments as well. But these are investments where we have a losing position, where we own a ETF or stock or mutual fund, but we're losing on it. We have an unrealized loss. What's nice about having a taxable brokerage account is that if you do sell an investment at a loss, you get to take advantage of that loss. That loss can help offset other short-term gains or other long-term capital gains. So it can be used to reduce your taxable income from those other sources, which is really nice. So some people, it's called tax loss harvesting, which a lot of people will go to sell an investment towards the end of the year. And let's say they have a $5,000 gain over here on, let's say, Apple stock, and let's say they have a $1,000 loss on GE stock or General Electric stock, for example. Well, the loss from General Electric is going to help offset the total taxable gain for Apple. So instead of paying tax on $5,000, now they're only going to pay tax on $4,000, which is quite nice. And even if let's say you have no capital gains at all. Let's say you want to sell an investment, you know you're going to take a loss, then what? Well, if you're going to take a loss, what's nice is you can actually deduct up to a maximum of $3,000 per year on capital losses, which is quite nice. If you take a larger loss than that, what happens? Well, what's nice is that loss is going to carry forward into future years and can be used once you have other capital gain income. So it's going to offset that other income, those other capital gains, once you have that. So that you don't lose the loss, it carries forward indefinitely until the day you die. And there's special rules that come into play when you die, especially if you're married. But I covered that, or I talked about that in my other video on capital gain taxation. So make sure to check that out. Okay guys, it's time for the 5th and final tip. And I think this one is the most important of all. And when I first started investing, I was just trying to wrap my head around how do you even do investing? How do you analyze stocks and all this? So I wasn't thinking about this initially, but as I got older and wiser, as they say, I started thinking more and more about this. Is a lot of people, they have multiple types of accounts. So for example, my wife and I, we each have a Roth IRA, and we also have a taxable brokerage account. Well, that's 3 different investment accounts right there. So what I've learned over the years is that, especially if you're somebody who wants to invest for cash flow, if you really enjoy dividend investing, you're gonna like this, because dividends are normally taxable. But what you'll find is if any dividends you put in any investments you buy within your Roth, they're going to be completely tax-free. Even if you're receiving dividends, as long as the investments are held within a Roth IRA, they are tax-free. And so, which investments might you consider putting more so in a Roth than a normal taxable brokerage account? Two perfect examples is real estate investment trust, known as REITs. The other one is master limited partnerships or publicly traded partnerships. There's two things about these type of investments where I think they'll benefit from being in a Roth IRA as much as possible. First, with REITs, I don't know if you guys know this, but REITs, no matter how long you hold the investment, when that dividend is paid to you, it's always going to come to you in the form of an ordinary dividend. So you'll never receive qualified dividends from REITs. It's not allowed. So what that means is you can never get lower tax rates on those dividends. So with that being the case, those are a perfect investment to stick in a Roth IRA, because even though the dividends are ordinary dividends, all the money, all the dividends you receive from that investment are completely tax-free. Same with master limited partnerships or publicly traded partnerships. Those entities, the reason I mention those is with REITs and those publicly traded assets, a lot of times they have higher yields, like 4, 5, 6, 7%, sometimes even up to 10%, depending on what you're invested in. So those are great examples of what you might place in a Roth IRA. Okay, the next thing, so now let's say you've maxed out your Roth IRA over here. Now, what kind of investments might you consider putting in your taxable brokerage account? Or what strategy might you implement more so in your taxable brokerage account? Well, if you want to do growth investing, if you're all about growth and you don't care so much about dividends, a taxable brokerage account is actually a really good place to do that. Because remember, even though it is taxable, if you hold the investment long term, you can still get the lower, more favorable capital gain rates. Plus, remember, you don't pay any tax at all until the day it comes when you sell the investment. So if you want to do growth investing, I think a taxable brokerage account could be a good place to do that. The second thing you can do is if you want to buy bonds, you might consider buying tax-exempt muni bond. But I think there's several different types of ETFs that are tax-exempt that kick out tax-exempt interest or dividends, so that although you are receiving income that would normally be taxable, it's all tax-exempt, so it doesn't affect your taxable income whatsoever. So that's really nice. The last type of investment, or the third type of investment you might consider placing in a taxable brokerage account, is your lower yielding investments. So let's say that some companies pay 3%, 2%, or even 1% dividend yields. Those are the ones you want to place in your taxable brokerage account. The companies that pay, or the ETFs that pay higher yields like 4, 5, 6, 7%, those are the ones you want to stick as much as possible over in that Roth IRA thing, because that's where you're gonna reap the more of the tax benefits on those. So as you can see, just by being strategic about where you place what type of investments, you can save tax there. Now, it might not look like a big tax savings up front, but over the course of your lifetime, ladies and gentlemen, it really adds up, especially as your account grows and that compounding interest kicks in. You want that compounding interest to not only be growing your account, but you want to be minimizing your taxes the whole way through. So let's just recap real quick to make sure you guys understood all this. So the first two tips really is to be a long-term investor. Why? Because by being a long-term investor, when you sell investments or when you receive dividends, qualified dividends, you're going to pay a lower tax rate on those investments because those are subject to capital gain rate treatment. The third thing we talked about is deciding when to sell your stock or ETFs. Consider only selling some in one year and a little in the next year to keep your overall income low so that it doesn't bump you up into those higher tax brackets on all of your income. The fourth tip is to use your capital losses to offset capital gains. And the fifth tip we just discussed, which I think is the most important of all, is be strategic about which accounts you use to place which investments. By doing that, it's going to be a very simple way for you to minimize taxes throughout the course of your lifetime when investing. I do caution you guys though, don't focus everything you do around taxes. Only do these tips, only implement these strategies if it makes sense for you based on your long-term investing strategy and your overall goals. But hey, if it makes sense, if it aligns with what you're planning to do, then go for it, because you might as well pay as little tax as possible, right? At least that's how I think about it. All right, guys, those are the 5 tips I have for you today. If you liked the video, let me know by crushing that like button. I'd really appreciate it. Also, feel free to share this information with a friend, especially if you know somebody who's really into investing or who's trying to learn more about this stuff. I think these tax saving strategies could really benefit them. Last but not least, if you have not already subscribed to the channel, be sure to do so by hitting that red subscribe button down below. And also, if you hit that little bell notification icon, it will notify you every time I post a new video. I try to post a new video on this channel about once per week. On Money and Life TV, we're all about helping you become fiscally fit. And as you guys can see from the canvases behind me, we teach finances, investing, taxes, and so much more. So make sure you subscribe to the channel so you do not miss any of our future uploads. All right, ladies and gentlemen, leave your comments, your questions, and all that good stuff below. I'm looking forward to reading what you guys have to say. Until next time, wherever you're at out there, I hope you have a wonderful week, and I'll see you in the next video. Live life uncaged. Bye, guys. Peace.